Welcome to Independent Thinking by Highlander Financial Group, your go to YouTube series where we dive deep into the world of finance and business. Join us as we engage with top industry experts to unpack the trends and issues shaping today's investment landscape. Whether you're looking for insights on emerging opportunities or strategies to navigate market challenges, we bring you the independent thinking that you need to stay ahead. Let's explore the future of investing together. Joining us today on Independent Thinking by Highlander Financial Group is Anshi Dong, the Global Head of Sector Strategy at State Street, who captains a team of sector research strategists to deliver actionable investment insights and thoughtful leadership related to sector investing. In this role, Anshi drives marketing campaigns and sales initiatives while partnering closely with investment, product, and marketing teams to advance sector ETF business strategy and optimize product positioning across retail, intermediary, and institutional channels. State Street Investment Management is one of the world's leading investment management firms, providing innovative investment solutions, global market expertise, and institutional quality strategies that help shape today's evolving financial markets.
Well, hello out there in HFG land. My name is Casey Craig, and I'm the founding partner of Highlander Financial Group. And today, boy, oh boy, we are excited to have Ms. Anshi Dong with us. Anshi is the global head of sector strategy for State Street Investment Research and their ETF lineup. And Anshi, thank you so much for being with us today. Welcome.
Thank you for having me here. Very exciting to talk about the sector opportunities today.
Absolutely. Great. So, in particular, the paper that you and your team wrote that we're talking about today is a paper you titled U.S. Industrial Revival: Opportunities in Asset-Heavy Cyclicals. So it's really a paper about the fact that some of the industrials in the U.S. S&P 500 industrial sector have been rallying, and you wrote the paper about a month ago, but the rally is still kind of happening as we speak. So I guess our first question is it highlights this potential revival in U.S. industrials, and maybe you could highlight for our clients in a basic way. So what's actually driving that shift right now?
Yeah. So we believe the current industrial revival is driven by two big forces. Mm-hmm. First is the pro-capex fiscal policy support. And the second aspect is that rising demand for physical assets for various reasons that I will dive deeper later. Mm-hmm. So when it comes to fiscal policy, we are seeing a particular impact from the One Big Beautiful Bill. Specifically that bonus depreciation, which allow companies to immediately expense new capital investment for tax purpose. That's really lower their upfront tax. So companies are really incentivized to spend more and sooner on fixed asset and capital goods. And for industrials, that matters a lot because when capital spending restart, demand flows quickly into machines, equipment, transportation. That's one of the reasons we're seeing industrial activities and new manufacturing good orders momentum begin to improve after a long period of weakness. And besides the physical policy tailwinds, the worst demand for physical assets is at an inflection point, whether it's from AI infrastructure, national defense, resource securities, our supply chain resilience. So the cash flows tied to producing and controlling those critical resources have become more valuable. So that shift is really at the core of why the asset-heavy cyclicals are getting renewed attention.
Right. I'd like to pick on something that you said there that we've been doing a number of these interviews, and one recurring theme in everything is AI. And you brought something up there that I think is worth just examining just a little bit more. So part of the demand for industrials is the fact that the AI boom has caused a demand for physical facilities or whatever comes along with that. And so there's really two things I wanted to touch on. One is just how you know, it's common for us to think of AI and just think of it in terms of, you know, Chat GPT and what it might do for us, or Copilot and what it might do for us on a daily basis, but we're not thinking about all the things that it drives in terms of business that are, you know, sort of necessary in order for AI to even exist. And then, you know, there's this idea about jobs, right? And that AI is going to take jobs away. But we see things like the, you know, the build out of facilities. So, any comment on that?
Yeah, so I definitely share that perspective that
Yeah.
AI may feel like digital. They live on your computer, live on the
Right.
cloud. But the AI infrastructure is really capital intensive and
Mhm.
require expensive like physical build out from data center and electrical equipment that powering the data center and cooling system that keep the GPUs running without overheating. And
Right.
all the hyperscalers are expected to spend more than like 650 billion capex this year. That
Wow.
represents like 50% jump from last year level. And we expecting this spend will continue increase for the next 3 to 5 years. And the reason behind that is that we all learn about this like agentic AI, which really started taking off since like the Anthropic launched the Cloud Code.
Hmm.
That's because we see like the power of AI, the capability have a big step up over the past 1 year.
Hmm.
That's really like increasing and escalating the AI adoption. Like computer demand is exploding. Like a lot of like AI software companies, they have to rationalizing their computing to meet this insatiable demand. So
Yep.
that's really create like a significant supply shortage and benefiting companies across the AI build out value chain. So
Hmm.
AI may feel digital, but the build out is physical.
Hmm. Yep. Yeah, that's really great stuff. That's great. Now, the asset heavy cyclicals, that bleeds into our second question, which is in the article you talk about asset heavy cyclicals specifically. Can you tell us what that means? What is an asset heavy cyclical?
Yeah, sure. So when we say asset heavy cyclicals, there are two parts.
Hmm.
Asset heavy. So asset heavy means like the parts of the market or companies, like they are closely tied to the real world, like physical capital investment and
Hmm.
production. Think about business that build and move and supply the physical economy, like industrial sectors or material sectors. And these industries really rely on like tangible and physical assets like equipment and factories, infrastructure. So historically, these businesses tend to be cyclical, meaning like their demands tend to rise and fall with the economic cycle. When the activity and manufacturing activity and investment pick up, they typically benefits. And that is kind of the opposite concept of asset light business, which is like a software, internet, and media business, which primarily focus on like intellectual property, like human capital, intangible assets. So that's how I put in like try to put in how to distinguish this physical cyclical part versus the
Hmm.
asset light part.
Yep. And it's interesting because we, you know, these companies obviously still exist, but we don't talk about them as much in terms of the broader U.S. market and its bull run that it's on because of you know, the technology and AI companies, the Mag 7, for instance, leading the way. But we've kind of got this perfect storm for industrials right now in the sense that, you know, we've got infrastructure need, we've got government policy that's lending itself to this, and then, you know, other things like, you know, reshoring, et cetera. Is that a good way to put it, that it's sort of like a perfect storm for industrials right now?
Yeah, I think definitely there are like a near-term cyclical cycle
Mhm.
uptrend that playing on top of the structure like structural shift that you mentioned, from like the rebuilding the supply chain for resilience, and then aerospace and defense. Don't forget, like the national security become a higher priority across the world, and also so those are and also natural resource security, because building things, you need materials, you need a natural resource like minerals and critical minerals for the computer chips, and then the energy resources. So all this really, like you described, create a perfect storm that have the cyclical, near-term tailwind from the fiscal policy side, as well as structural tailwind that may last more than the next 12 months.
Yep. So that's a good, just breaking down sector investing. So we have the S&P 500, but within the S&P 500 there are 11 main sectors. Industrials is the one we're talking about today. That's and technology is another. Healthcare, you can go down the list, but so State Street, your company, produces products that Highlander uses and other investment advisors use to deliver a part of the S&P 500 all in one sector, right? So we can buy one of these products for a client and put it in the portfolio, and that gives them exposure to that particular sector. And one of the things that advisors often talk about, or we might sometimes talk about with clients, is that when the S&P 500 itself is not all heading in an upward direction at the same time, sometimes we can dive deeper down into a sector that can be experiencing tremendous performance, even though the overall S&P is not performing well. Well, certainly the overall S&P, at least at this moment, year to date, is doing well. But earlier in the year, we were facing a lot of headwind, and so this would be an example of a particular time when this sector is far performing many of the sectors within that group of 11. Correct?
Yep. That's correct. Yep. And we have the 11 sector products correspond to captured as S&P 500 GIG sectors.
And another example of this, I guess that's apropos these days, would be the energy sector having a big run as a result of what's gone on, in the increase in price of a barrel of oil, no matter what kind it is, really. So you saw the energy sector, which is another one of the 11 that kind of took off. So that leads me into the article suggests that this particular sector may still be undervalued. Do we have any factors that might be causing the disconnect between those fundamentals and just the market pricing?
I think the disconnect really comes down to like the valuation gap between the industrial, those physical, asset-heavy cyclicals versus the asset-led sectors like tech. And then combined with like still very low ownership by most of the investors in their portfolio. And so from valuation perspective, markets are still recalibrating like after more than a decade of tech-led leadership.
Right.
And for years, like investors reward like asset-led business models, intangible capitals. But that regime hasn't disappeared overnight. So there's still people, as we see, like over the past 1 month, tech is back to leadership. Mm-hmm. But on the other hand, the physical assets have started to show some kind of valuation readjustment because of that increasing demand for physical assets that I mentioned earlier. And so but there's still a big gap between the two segments. Yep. If you look at price to book ratio, industrials continue to trade at a meaningful discount relative to tech. So that gap reflects like years of underinvestment and under ownership in those sectors by most of investors.
Yeah, and I think it's just kind of like ironic that it's actually AI itself, the technology itself, that is bringing these sectors back, back around to their heyday. And just to add some color, this is not, this isn't breaking news that I'm giving here, but if you look at the Mag 7, there, depending on the period of time that you look at with the S&P 500, you can attribute at certain periods of time as much as 60 to 70% of the total return in the S&P 500 to those 7 companies, which of course are the big boys like Nvidia and Amazon and the like that are driving a lot of this. So that's what we're talking about when you've had those companies driving so much of what's going on for so long. There's a lot of leg room or runway, I guess, left for other sectors like this one, that really what we're talking about here is industrials and materials becoming part of the AI trade. Actually, the AI, what we define as the AI trade is kind of like redefining itself as we go.
It's broadening out. The AI trade is broadening out.
We've talked about. I listen to Bloomberg as I'm driving from client to client, and it seems like every year they keep talking about this is the year where the market gains depth. This is the year where we're going to get the depth that we're looking. And while the fundamentals are there and it starts to happen, AI just takes back over, and it's going up so fast that we haven't really seen the depth. But this is an example of a year where we're still having a good year, but energy and industrials in this case have had periods of time where they've actually outperformed the tech stocks. So maybe we're starting to see some of that, and that might be a good segue into the last question, which is about risk and uncertainty. So what are the key risks or uncertainties that could challenge this particular part of the market that we're talking about today over the next couple of years, do you think?
I would say the biggest risk could be a sharp deterioration in economic momentum. If manufacturing activity start to rolling over, or growth slow down materially, cyclical sectors like industrials, or they feel that pressure the first.
Yep.
One potential trigger for that deterioration would be the prolonged energy supply shock, something that really meaningfully raise the input costs for a lot of industrial activities and creating tighter financial conditions, and may potentially force companies to postpone investment plans. But that said, we think the bar for significant pullback in CapEx, especially AI-related CapEx, is quite high.
Yeah.
Because a large share of AI infrastructure spending is being driven by the largest, most cash-generative big tech firms, as you mentioned. And for them, this AI investment is not optional. And a major part of this AI risk they are vying for is about compute and infrastructure. So to stay competitive, it requires continued spending on AI infrastructure. So as a result, we think AI CapEx is increasingly structural rather than cyclical. So making it more resilient, even if we may have some broader economic softening.
Great answer. Yeah. Well, this has been great, Anchi. We hope you will come back and see us again soon. We'll have plenty of questions, I'm sure, as the year goes on, and I know our clients enjoy these videos a great deal, and we owe you a debt of gratitude for being our guest today. Thank you so much.
Yeah, it's my pleasure. Also, I would like to mention that we do publish our quarterly sector market perspective and provide our outlook for the 6 to 12 months investment horizon across the 11 S&P 500 gig sector. So I'm more than happy to talk more in the if you feel those type of insight is valuable, happy to come back.
I'm glad you said that, because you really set yourself up when you said you published that. I was thinking, well, we're gonna call you and ask you to cover it with us then. So that'll be that's something to look forward to. Thank you so much for that.
Yeah. No
Okay.
problem.
Okay, well, thanks everybody out there at HFG Land for watching, and we hope that you enjoyed today's video and that you'll stay with us because we're going to produce plenty more of this stuff as the year goes on, and we appreciate it as always. So thanks and have a great day.
Yeah, thank you. Have a good day.